Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Monday, May 29th, 10:30 a.m. in the UAE, at least. I'm not sure what it is everywhere else on the planet. It all depends where you are, of course, doesn't it? But in Singapore, where we are traveling this morning, in London, it's Singapore 4 hours ahead, London 3 hours behind. Dubai is the number, and that's where we're going to start this morning with Omar Najia, Global Head of Derivatives at BB Energy, which itself is an energy trading firm spread all over the world. Brent is up this morning, but only a very little pop, you would say, Omar, given the scale of the news over the weekend, the debt ceiling deal in the United States. It felt like it was going to be the gateway to a big surge upwards. Is that still to come? Your thoughts?
I mean, I'm bullish crude, but I mean, why? It's quite amazing. So they did a quote unquote deal, right? The market was anticipating a 97% probability of a deal and 3% probability of no deal. If they did a no deal, then everything would implode and the people doing the no deal would lose massive amounts of money and wealth. So it's staggering that people are believing like, wow, yeah, they did a deal. Isn't that amazing? Yeah, so that's the reason to buy. They did a deal. It's unexpected. No, I think basically the deal is expected. I don't think, 97.3%. So clearly expected, very much expected. So a little bit of a damn script. They do this all the time, right? And we're gonna say, no, yes, no. And if they don't do a deal, they lose money. So there's no way that they're not going to do a deal. So I don't think that's. I don't think you'll see an effect as such. I think the market is bullish on oil, in my opinion, unless we take out the 63, 62 low on WTI, and on equity markets. Maybe some people will use it. I'm sure the mainstream media will say, "Look, they did a deal. Everything is bullish now. Buy." And all this kind of stuff. But I'm a bit worried about those markets as well because fewer and fewer companies are actually providing the gains to stuff like Nasdaq and the S&P. It's a very, very not thin market. It's the stuff that's moving the index up is becoming very, very narrow. So it's not a broad-based rally. It's a very narrow rally, and that does not look good longer term, basically.
Let's welcome Bora Berryman, Managing Partner at Hormuz Straits Partnership, sitting in London, the city of London, the financial center of Europe still, I think. Bora, your thoughts the morning after, the night before. Does Europe care that a deal has been done? Does it make any difference? Is it a non-starter, as Omar's indicating?
I think sophisticated Europe should realize that this is part of the two-party theater that we've known to live with in the United States. And I think there are aspects of this agreement that remains to be sort of hammered out that might be a bit different. Without, as I understand it, there might not be a specific debt cap in this agreement, just sort of a suspension through an agreement to limit the growth in spending for some time. But, looking back to the Clinton administration and the Obama administration, these Republican threats usually help reduce the slope of the increase in the US debt during Democratic administrations. And they have pretty good economies. The problem is when the Republicans are in, the Republicans in Congress take their foot off the brake and put their foot on the gas, and you see the massive, leaps and bounds in debt as we saw during W. Bush and Trump. So I think overall, this could be a step toward hopefully normalizing things because, we have 31 trillion in debt. That's 122% of US GDP, but it's lower than the 132% that we had about a year ago. And I think all eyes are really on, again, I hate to repeat myself, the Fed policy, because that's where liquidity has really been sucked out of the market by the uncertain outlook for inflation and uncertain outlook for Fed rates. And Europe is hoping for some type of normalization that will trickle down to them.
Let's welcome Serena Wong, head of APAC analysis at Vortexa. Serena, the noise around the debt ceiling tended to sort of cloud out everything else that was going on in the markets, the China recovery narrative, where is inflation gone, what is the interest rate cycle, the war in Ukraine. They all seem to get smothered by the big noise of the debt ceiling, which essentially was a great drama media story, if an empty bubble or not, as Omar indicates, but nonetheless, it dominated the headlines. Now that it's gone from the headlines, or will drift away in the coming days, what narrative will that allow to emerge that was of more relevance to the direction of the energy markets?
Hi, Sean. Thank you for having me here. And well, I guess at the end of the day, the oil price will now be very much driven by fundamentals. And if you look from a demand fundamentals perspective, first of all, it's very mixed bag, right? And we've seen statistics about how, on the optimistic side of things, the US PMI surprised on the upside last month. India's PMI has been very relatively strong. But if you look towards China, which is one of the biggest importers of energy, right, it is struggling to a certain extent, especially on the manufacturing side of things. And we've seen how industrial profits last month has really fallen by 18%. Government is trying to stimulate the entire economy, but the market participants are cautiously pessimistic about how much that economy can be stimulated. But of course, we see strength in mobility to a certain extent, whereby the reopening of China's economy has increased traveling and kind of fuel jet demand. So I'll say that the market is really closely watching from a demand perspective how some of these key economies are performing. But at the same time,
on that point, just on the news of today, we have came out over the weekend, China's industrial firms, the profits of China's industrial firms fell in the first 4 months of 2023 with profits down 20%. That kind of seems to reaffirm the narrative that China's reopening isn't quite the bullet train that many were hoping or expecting.
Yeah, I fully agree with you. And at the end of the day, what's really struggling right now is their industries, particularly the cement, the steel industries, and it's all pointing down to a slowdown in the wider global economy when these industries are actually, suffering in terms of their profits.
Omar, the momentum for the upward movement in oil prices that you're forecasting, the sort of bullish outlook, we've had that a significant now consistent rise from the recent fall back towards $70 on Brent. And I think even it broke through 70 on WTI, but both are now surging. I mean, continuing a continuous upward trend through the month of May. As we get to the end of the month, your sense of what gives that oxygen to continue the upward momentum when we had a recession announced last week in Germany, technical but nonetheless defined as a recession. China's recovery is still a little bit, as indicated there, not quite at it yet. What gives this continuous bullish outlook for an upward trend in oil prices as we go towards the end of the second quarter?
I mean, think about it like this. If the logic is that you need something that you can point at and say, that's what it is, it could be anything, right? But the real question is, if China's, going to be like really bad and I don't know what, blah, 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 and if a recession is going to be blah, 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 Germany and, death and destruction there, why is the S&P and NASDAQ and the Dow Jones going up? Why are the European indexes going up, right? So I think it's
liquidity at the end of the day. There's been $10 trillion printed in the last decade. It hasn't disappeared. It's still looking for a home. Inflating asset prices. I mean, another $1 trillion tech company with the NVIDIA.
Yeah, but okay. So you've got to kind of the markets, the function of the markets aren't, a place where you can put $10 trillion, whatever. The function of the market is to have basically price discovery. So to know what the value of something is, right? So when you have, markets which are, dislocated, you can have this thing where basically somebody has 10 trillion and they follow this chat GPT or AI or whatever it is. And basically they say, right, buy it. So they kind of, take the brain aside and follow what somebody's telling you, but there is no price discovery, right? So all these like ETFs, right? So NVIDIA, right? If the NVIDIA is part of the ETF, then the ETF by definition has to buy more of it if its market cap has increased, right? So it's a self-fulfilling thing. There's no brain work, there's no analysis, there's no thought. There's just, there's $10 trillion, let's put it, chat GPT, AI is the future, blah, blah, blah. I mean, that kind of thing might be, exciting or whatever it is, but it's worrisome. It's worrisome if people think
that's the argument I'm making. It can continue to give an upward motion to equity markets because of the kind of herd mentality, whereas the physical oil markets will tend to be more sober around supply and demand fundamentals.
The physical oil markets trade at most, there's 100 million barrels of demand a day, physical demand, of which I would say about 80 million is basically, producer to end user. 20 million barrels a day.
The net interest in the markets has declined over the first half of the year. The fund managers, the paper money's left the market.
No. So basically, that's the physical market. The futures market trades 100 times a multiple of that, right? It trades billions of barrels a day. It's a financial market. It's got nothing to do with physical supply and demand, which people don't seem to understand. So even though it's called Brent crude oil, and even though it's called WTI crude oil, and you got heat and RBOB and all the rest of it, they're financial instruments. Yes, even though they're deliverable, they are financial instruments. You've got so much money that's in them. Very little has to do with actually physical supply and demand and people hedging or not hedging or whatever it is. You have a physical market, which is basically Platts, which trades 20 million barrels a day. And then you've got a futures paper derivatives market, which trades billions of these things. And it's much bigger. And the reason it's much bigger is because in the West, everything is financialized. So that it's people make a mistake of thinking that oil is a commodity and all this kind of stuff. True, but before anything else, it's a financial asset by far and away.
Bora, on that point, we had the Saudi energy minister last week, and a senior official from OPEC on a stage in Dubai, and the Saudi energy minister was speaking. I can't remember what conference he was at, but nonetheless, they were both signaling a warning to that financialization end of the oil markets, to what they call short sellers, those who are betting oil prices will fall, and they were warning them. This is a sort of continuous warning now of the last sort of number of years. Is this a fight that OPEC Plus can win, that the Saudi energy minister can face down the financial markets of the energy trading world?
Look, I think they have the right to consider it.
Sure.
And I'm not sure I'm the expert to sort of ratify whether OPEC Plus buys that title of sort of the other central bank or the central bank of oil. Do they embrace that or not? But they are trying to like calibrate a very volatile scenario, just like the US Fed. And I think they might be the, second most important sort of economic body in the world today in many ways. What the markets see is that the Fed is sticking to its tight money policy for the time being, right? That we expect another increase in the Fed rate, and they see that it's unlikely that this policy will change due to the strong inflation picture. The inflation picture is still very robust, as you see in the UK and the US, throughout Europe. I mean, there are relative gradations between whatever Germany and the UK, but it's still way above target inflation in the advanced economies. Hence, they're thinking there needs to be a kind of a hard landing, a la early 80s, where rates continue to go up, and then markets get the picture that they're out of liquidity and there's a hard landing. And I think OPEC is kind of fighting against that by saying, look, then we can reduce supply, or we can cut our quotas, and things will balance in the end, so don't short oil. And
well, the specific reference to mention this, of course, because it's of great relevance this week with OPEC having their meeting at the end of this week, as to whether they will move to cut further in order to sort of knock out those shorts. Do you expect them to take further cuts on that point of supply demand, keep prices propped?
Omar, please correct me, but my view is most of these countries are already producing below their quotas, right? So, cosmetically, you can sort of reduce quotas, and then Saudi Arabia and the UAE do the real work, and the rest of them can kind of fall into psychologically kind of give a signal, look, we've reduced our quotas down toward where we're actually producing, and kind of send a bullish kind of hardline message to the markets at relatively little cost, because there isn't some like big demand coming out of China, right? So it can be done.
The issue, from the point of view of where Asia and China goes, is certainly something that we're looking at. And Serena, when you look, the even though the China economy in the first 4 months of the year, and now 5 months, hasn't quite got back to sort of full throttle, and many are predicting that it won't, and it'll have more of a sober second half than a bumper one. But in either case, they still seem to be importing a lot of oil. I suppose they can't turn their nose up at cheap Russian oil. Do you expect that the imports of crude into India and China, and that Asian import numbers will remain high regardless of how strong the economic performance is?
Yeah, that's a really good question. Well, right now, if you take a stock taker, what's happening is that in the most recent month, the imports of crude, especially into China, has been very much affected by the heavy refinery maintenance that is happening between April, May, as well as June. But by July, we expect that these refineries will be ramping up their crude runs, and the crude purchases would have started by now, assuming that it takes about 1 to 2 months from the time that the deal was being made to ship the crude all the way to China itself. So that is the reason why we're actually starting to see a pickup in terms of crude being shipped over to China. And we expect that will continue as the refineries start to ramp up. But what we are not bullish about is how high the imports will go, and that really depends on the demand in the second half of the year. But if we look at the seasonality factors, Q3 and Q4 is typically the seasons where we see seasonal support coming from construction activities, winter activities, potentially some more industrial activities that is picking up. So from a domestic perspective, there are potential upsides for the Chinese oil demand. But from an exports perspective, well, how high the refiners will actually be running their crude will depend on the export margins. And if margins do not improve, we expect that they will keep their exports relatively curtailed.
Let's go to the survey question and to touch on some of the issues that we were talking about earlier. Will the debt ceiling deal now be the catalyst to allow oil prices to break above $80 a barrel? Basically, the thesis I was presenting earlier the big noise on the debt ceiling has kind of been a wet blanket over the markets of uncertainty. Now that it's gone, we had the banking crisis in March, we had the debt ceiling crisis in April and May, kind of kept a wet blanket on it all. But now that they're behind us, is it finally the gateway to $80 plus? Yes or no? Welcome your views on that. Omar, sort of taking a slight different tack. I wanted to get your opinion on the decision on the election result in Turkey this weekend. Yesterday, Erdogan has won re-election and now has 5 more years. Your thoughts on obviously the geopolitical relevance of that, its relevance to the energy markets, to the region. Just connect some dots for us there, please.
So basically, his opponent was the favorite of the West, NATO, US, blah, blah, blah. And the fact that he won is actually, very, very, I mean, it's bad for the West because it means that Turkey and Erdogan will still play that game where he walks a thin line between, Russia and the US. His relationship with Putin is excellent. Don't forget that they did the deal about the Turkish hub, energy, blah, blah, blah. The Europeans don't like him at all. So I think it's, in terms of the oil market, I think, he'll keep trying to mess with Iraq and Kurdish flows out of Seyhan. So I don't expect that will change. Or if it does, he'll extract some kind of, advantage, favor, money, whatever it is from it. But, I think, geopolitically, Turkey will not move into the Russian sphere of influence, will not move more towards the BRICS because, I think the Saudis are joining the BRICS bank, the Saudis, the UAE, all the other, a lot of other countries as well. But Turkey doesn't have any kind of advantage as such to allow it basically to break away from NATO and the West. So I expect they stay in NATO, stay with the West, and just walk that fine line and try and maximize from both sides. But, I think it's definitely a negative for the West. They'll have to wait another 5 years to get him out. And of course, they were the people who orchestrated the attempted coup. They were the people who were saying during this election, they know, vote for this guy, I don't know what. And the foreign minister in Turkey said, went nuts. So I think it's negative for the West. And
that said, Bora, welcome your thoughts. Obviously, Erdogan did sign off on Finland joining NATO only a few weeks ago, which of course is the biggest European border with Russia. So he certainly, that's still a very big partnership of the Western military alliance. This outcome, your thoughts on it, as on a weekend also where it does look like things are heating up once again on the battlefields in Ukraine?
There are several aspects of the debate in Turkey that I think the world should, focus on. I'll look at the economic bit. I think the message from the Turkish electorate is they prefer to have growth and employment and will swallow inflation because they have definitely voted for printing money. So they will continue to have inflation. But look, the Turkish growth outlook for this year is 3% or more. Turkey generally overshoots the growth outlook from the IMF. So that means something, right? I think we in Europe get that. You're not even making 1.5% in Western Europe. They are just printing money and pushing out credit to back their exporters in Turkey. I think that's what the electorate broadly voted for. I don't think that will translate into the electoral preferences of other nations, but that's where Turkey comes out. And for this industrial base that is being supported with printed money in Turkey, you need access to cheap energy. So Erdogan has also told his people, I'm not going to make a self-harming sacrifice to sanction Russian oil. He's saying, I want to maintain good relationships with Putin on the energy front and continue to sell drones to Ukraine to preserve Ukraine as an independent entity, not let it collapse. So he's basically banking on, I think, what we should all be expecting in that situation. Russia will continue to be a major hostile power after this war, and Ukraine will continue to be an independent country after this war. It's not that one will knock out the other. And I think that balancing act
On that,
makes sense.
just to follow up, Bora, do you expect the financial city of London, the global investor class who look for returns in emerging economies and have been putting a lot of money into emerging economies this year, will return to Turkey with Erdogan's re-election?
It's hard to say. There is a camp of Turkish analysts that say, this was kind of a pre-election strategy of Erdogan. Now that he's been re-elected, he'll become more conventional and raise interest rates and cool the economy a bit. That might cool the growth outlook, right? And that would bring in, I think, what we call in Turkey hot money, kind of international flows. But it's hard to say. The system in Turkey gives a lot of, there aren't checks and balances like the US. It's up to Erdogan, but that also makes the right decision, if I may say that orthodox economics are the right decision, easier to implement and quicker to deliver results. Because what's happening in Turkey is just the direct outcome of the policy of Erdogan. It's not something contrary to his policy. So if he changes his policy, you'll get an inflow of international funds. But his policy has been to basically self-fund through internal Turkish sources his aspirations without going and borrowing on the international markets. He didn't want to be dependent on kind of US and European capital flows to achieve his objectives for the time being. But it's all up to him.
Well, let's see where that goes. Serena, last word to you this morning with the survey results. A big, large no that the debt ceiling is going to clear a pathway to $80 oil. Possibly good news for most consuming countries in Asia and the APAC area, Serena. While China is recovering from its COVID period and is showing some growth, where do we see the outlook for the rest of the APAC region with oil prices at these levels, a relatively strong dollar, not as bionic as it was? Can the rest of Asia continue to grow with China into the second half of the year and keep that oil demand, that marginal Asian oil demand, higher?
Yeah, so if we look at the performance in terms of the economic indexes, right, we see pretty strong strength coming from India, even surprisingly Southeast Asia. And I like to say that although oil prices are a good indicator of growth, but a lot of times this is going to be in a way influenced by how much government subsidies are actually provided to kind of curtail and stem the inflation and make the fuel, especially the transportation fuel, affordable to the people. And I believe that's one of the key reasons why, even though oil prices went up really high, last year, right, and even this year, although he has come down, but inflation remains really high. But from an oil consumption perspective, we still see really strong and resilient oil demand coming from India and Southeast Asia, and that's because of the affordable prices made to the people. So pretty optimistic about the second half of the year in terms of oil demand.
Well, the oil demand picture, at least as painted by the major multilateral energy agencies, the IEA and OPEC itself, still is forecasting a 2 million barrel a day increase in the second half of the year from where we are right now. So all eyes on OPEC, OPEC Plus meeting at the end of this week, whether they will consolidate the cuts from announced last month, which of course were voluntary and technically outside the OPEC Plus organization, whether they bring those cuts, those 1.6 inside the tent, formalize them, and maybe even add extra cuts. That will be the sort of question of the week, really. Where that goes, we'll have to wait and see. But thank you so much for taking the time to be with us this Monday morning. Bora Berryman in London, Omar Najia in Dubai, and Serena Wong in Singapore. As we said at the top of this show, Brent crude oil trading a little bit higher on the news of the debt ceiling agreement, but I would say just a fraction, up 0.5%. Doesn't seem to be too bullish coming out of that agreement. And maybe that was all, as Omar said, already priced in. Thanks, everybody. Have a great week. All the best.
Thank you all.
Thank you.
Thank you.